Hello, Newsweed fans. This is Gary Loss with Newsweed, and I wanted to bring you an update on inflation because I think it's on a lot of people's minds, and I think it's something that we need to talk about. And I don't want to panic anyone about it, but there are some things that are happening that are concerning, and I think there's signs and indicators. So I want to go through this and just explain what my concerns are. So, first of all, from Yahoo News, a hotter than expected consumer price index, otherwise known as the CPI, last week tempered some of the investors' ebullience for equities and suggested heightened inflationary pressures were stickier than previously expected. Well, possibly so, that they were stickier than previously expected, except if you're a consumer, they're not unexpected because we've been dealing with these for a while. You go to the grocery store, you go fill up with gas, you buy almost anything, and you experience a little bit of sticker shock each time because things have just skyrocketed in price, especially essentials or staples like food. And then from the Corporate Finance Institute, this is what I want to explain. So going back for just a second, these were talking about not just the CPI, but about equities. And why are equities so important? Well, as it explains here, equities play a pivotal role in supporting a market-based economy, which is what the United States has. Okay. We have a market-based economy because it's a bridge between providing capital to companies who require it and giving investment opportunities for consumers or investors. When equities go, and the equities market is roilable, it's easily affected. When equities go, uh, it's a double whammy. To begin with, this means that people might start to panic a little bit. And when they do, and they sell their stocks, and the market corrects, the equities market corrects itself, what happens is that means companies have less available capital for investment, for buying equipment, for paying salaries or healthcare expenses. And what happens is it leads to rounds of layoffs or just letting people go or diminished salaries or diminished raises. So there's a host of things, and it can snowball into the general economy and cause headwinds in such a way that overall GNP or GDP slows down, and then it can trigger a potential bigger problem with the economy. Not a depression per se, but maybe a form of a recession or just a low grade sort of growth. And that low grade growth is important. Now, Ian Shepherdson, who's a chief economist for Pantheon Macroeconomics, put it this way: we think core inflation will peak at 7% in March. Okay, this is going down the road here, which means it's going to be steadily climbing until that point in March, and which will pose a serious challenge to the Fed's benign median term view. And then he's talking about Chair Jerome Powell of the Fed will have to convince markets that the combination of rocketing payrolls and soaring inflation does not threaten the what he's been calling the transitory story. You know, you keep hearing this. It's transitory. It's transitory. It's temporary. It's going away. We're going to be okay. Um, Meanwhile, people don't feel that way exactly, right? We feel concerned. But he is stuck to this story so far. And now there's almost like a psychological component where they have to double down and stick to this narrative, even if it's not true. Um, this could cause big problems later on down the road, just for the reasons that I explained before. One more point here. Thomas Barkin, the head of the Richmond Federal Reserve Bank, actually sounded a little bit of the alarm here, saying, I personally think it's very helpful for us to have a few more months to evaluate. Is inflation going to come back to more normal levels? In other words, 2 or so percent. As right now, it's nearly 5%. Is the labor market going to open up as people spend through some of the savings? Those are good questions, Mr. Barkin, because the average consumer is concerned about these things and is concerned about paying, $4 or more for gas and paying $5 for a dozen eggs and so forth. These things are going to impact us and are impacting us currently. And then from the Wall Street Journal, in an article called Tipping Point, confident consumers have swallowed higher supermarket prices so far this year, but the risk of indigestion is growing. For companies that make staple goods, asking for more money is delicate. Let me unpack that for a little bit. Despite the fact that prices have risen and significantly and have stayed that way for months now, the problem is there's a breaking point. Companies are still making money because they are raising prices to offset the inflationary spiral that we're in. However, there's always a break point where all of a sudden the price gets too high for the consumer. The consumer cuts back on their spending. As they cut back on their spending, companies' revenues decrease. As companies' revenues decrease, they have to do things like stop investing or stop hiring or lay people off or not give raises. And all of these things are not good for the general economy and threaten us in a significant manner and could end up leading to a widespread recession. Now, you combine that dynamic with the idea that the equities markets get roiled, people start selling their stocks, and companies now have less access to revenue to do business. They need this money to do business, right? It's not just doesn't just magically happen. Companies just don't magically have money appear. They get it either through sales or through investments in equities. Both of these things are being threatened by this inflationary pressure that's going on right now. And at first, they kept saying, "Oh, it's not good. It's going to go away soon. It's going to go away soon." Well, maybe a little longer now. It's going to be March. They need to really get a handle on this because then, in an emergency measure, the only way to deal with this inflation is to raise prime interest rates, right? To suck some of the money out of the economy. Once you do that, however, and it does work, and Reagan did that, and they called it the Volcker principle. But once you do that, it's a very delicate balancing act because then borrowing becomes very expensive and expansion is dampened. Companies tend to cut back on their activity, on employment. All sorts of things can happen, and you can end up with stagflation for a temporary period of time until the economy readjusts. Now, the other thing that's going on here is this whole supply chain thing. That is not likely to resolve anytime too soon unless the Biden administration can get its job together, get its act together, and do something that intervenes in order to truly help this. So the bottom line here is that what the Fed is saying is not squaring with what consumers are experiencing. And until such a time that they start being a little more honest with us, and that this is not just a supply chain issue, that's a big part of it. That's probably the most part of it. The economy's overheating, people are coming back in and demanding, but we can't deliver the goods. But it's not just that. There's a ton of money that's been printed, so to speak, printed, conjured, whatever you call it, fiat currency. And more is coming down the pike here, right? Biden and Congress just passed the infrastructure plan, which is going to push another $1.2 trillion into the economy. Yes, it's going to take time to spend that money, but it's going to trickle in and it's going to compound what's already going on. Although they say it doesn't create any inflation because it's revenue, it's tax neutral, revenue neutral, whatever they call it. It's not going to really conjure money. That's what they say. But usually what happens is there's a temporary period where money is sent out into different sectors, right, as part of the promise of part of the economic package. And then later it's recuperated through taxes. But the money has to first get pushed out. And this sort of has a bracketing effect as that money works its way down. People at the top do really well initially. But then later, as that inflation accumulates, it hurts the average consumer. So this could end up coming back to bite the Biden administration and more importantly, to hurt the average American consumer. So I hope sincerely that the Fed really understands what they're doing here, and that Biden gets the bigger picture. Because if all of these things come together, if the supply chain uh, issues do not get resolved and potentially worsen, if the inflationary pressures continue, if this new spending infrastructure package worsens all of these things, if the equities markets become disturbed, all of that could end up being a perfect storm, and we could end up having significant inflation. Now, I want to make this clear. I do not believe we're going to have the type of inflation that was associated with the Weimar Republic, nor do I think we're going to have the inflation of even Venezuela. This is outrageous, 100, 200, 300% inflation, and wheelbarrows full of cash and people starving in soup lines and all this kind of stuff. I don't see that happen. But here's what I do see happening: 5 or 6, maybe 7% inflation, eroding our ability to save for the future, to send our kids to college, to pay for our mortgages, to pay for cars, which are already going up, right, due to the microchip issue or shortage. All of that could just end up hurting the average consumer and his or her ability to save for the future. And I think just as importantly, to have a decent quality of life now, to have enough disposable income to go out and enjoy life. I mean, after all, we don't just work to save, and all those things are important, but we also work so that we can enjoy life. I learned a long time ago, you don't live to work, you work to live. Money is a means to an end, and that end is enjoyment of life. And there's nothing wrong with that, and people shouldn't feel guilty about it. And when government puts in programs and structures in such a way that cause inflation, what they do is interfere with your ability as an average person to enjoy your income so that you can enjoy your life, right? They're short circuiting that and playing a very dangerous game. They're rolling the dice, and maybe it'll work out and maybe it won't. And maybe I'm just being a little paranoid. I can't say for sure. And I'm certainly no economic expert. But again, 5, 6, 7% inflation over time compounded ends up something like 20 or 30% per year. It eats away at your ability to do things in your life. It eats away at your ability to save, to send your kids to college, to buy the things that you need to buy, to make investments. And all of that puts a net drag on the overall economy, which again decreases raises and employment opportunities. These are all highly interconnected things. These are not separate things. So I'm sincerely hoping that they understand what they're doing here and the risk that they are taking. For Newsweed, this is Gary Loss. Have a great day. Bye-bye.